So hello everyone, we're going to talk about cash flow forecasting today, and understanding and predicting the flow of money in and out of your business can really help you make smarter decisions. It helps you plan ahead and ultimately avoid any unnecessary cash flow crises. So what we're going to take a look at is the agenda today, which is how to calculate your cash flow projections. And you usually calculate your cash flow projections once your business plan is complete, because almost everything from that goes into the cash flow projections or forecasting will come from your business plan. So having that business plan completed first is step one. Next, we're going to take a look at how to use your cash flow to forecast, to make data-driven decisions. So when you should be purchasing items, when you need to hold back, when you can invest more money in staff or equipment or advertising, or maybe you need to cut back. So cash flow helps you look at what you anticipate is going to happen in the next 12 months, based on research and based on your business plan. And then you can make better decisions as you're going through the year. And I'm also going to talk about sources of funding. There's a lot of funding available right now, depending on the nature of your business and depending on what you require the financing for and how much you need. So we'll talk a little bit about that, and that's where Janelle comes in really handy, because once she's seen your business plan, she's seen your cash flow forecast and how much money you're looking for and what it's going to be used for, she will be able to help you take a look at what resources are available and which might be the best for your organization. So I'm just going to talk a little bit about why small businesses fail. And according to research done in 2020, one of the reasons small businesses fail is cash flow issues. So that's why it's really important to have a good understanding of what your cash flow is going to be for the next 12 months. This includes poor cash flow management and poor understanding of cash flow. So since you're here today, you're going to have a greater understanding of what a cash flow is and how you use it. And starting out with too little money and lack of development of a business plan. So these are sort of some of the major reasons why businesses fail. But here's some interesting statistics. So 82% fail because of poor cash flow management skills or a poor understanding of cash flow. 79% start out with too little money. 78% of businesses lack of a well-developed plan, including insufficient research on the business they're starting. So it's really important to do that market research to identify who your clients are, what your target area is, what those trends are, and who your ideal customer is. 77% is not pricing properly or failure to include all the necessary items when setting prices. And quite often I find this in businesses that are more artisans or crafters or individuals who are making products, because quite often they don't take their time into consideration. So that's really important when you're pricing your products or services. 70% is being overly optimistic about achievable sales, money required, and about the needs what needs to be done to be successful. So what we'll take a look at here is, doing a realistic, pessimistic, and optimistic cash flow, and you'll be able to identify, and especially, in years 2 and 3, what's more realistic. The cash flows that I do take certain assumptions, but they're based on research, and I'm going to show you how I did that for a seasonal business. That's what the cash flow will be based on this time. And 70% not recognizing or ignoring what they don't do well and not seeking help from others. So a lot of businesses, when they first start, feel embarrassed about asking for help, and you shouldn't. I've been in business for over 20 years now with a number of different endeavors, and I constantly ask peers and other people for help because I clearly can't know-it-all. So having those support mechanisms is really important, and working with a small business office is also really important. These offices were set up to help you in all aspects of your business, so please don't be embarrassed to reach out to them. So when we look at cash flow, what is cash flow exactly? Well, cash flow basically is the lifeblood of your business. It's an essential resource that allows you to perform activities, make transactions, and keep your business going. Simply put, cash flow is money going in and out of your business. So there are times when you have lots of cash, for example, after you receive money from a big sale, and there's other times when you don't have so much. So maybe you've made a big purchase, or maybe sales aren't happening as quickly as you anticipated. So even a profitable, fast-growing company can face serious cash flow crunch while waiting for money to come in. In fact, it's surprisingly common for profitable companies to go out of business because they ran out of cash or they tried to grow too quickly. So some things that you'll want to take a look at or think about at least when you're doing your financial planning is, do you require more staff in the next 12 months? Do you require equipment or need to renew new supplies? Do you want to expand your business? Do I need other new resources? It could be technology or things like that. How will your plan affect your cash flow? So, whatever your goals are for this year and what you're planning to do, how is that going to affect the money coming in and the money going out? And also, do I need financing? And if so, how much? So once you have a clearer view of your particular situation, and you create your cash flow budget to see if you have enough cash available to implement your strategy. And if you don't, then you need to find ways to improve your cash flow. So the first cash flow you do might not be perfect. You're going to have to adjust it to get you through the year. Once you have the cash flow done, you're going to want to take actual numbers and put them in next to what you projected to see how close you were. So if your sales are lower, you're going to have to anticipate, okay, well, how am I going to build my sales next month? Or is there areas that I can reduce some of my expenses? So another few elements that are really important when you're taking a look at cash flow is your accounts receivable, accounts payable, and inventory. So accounts receivable is money that customers owe you for goods and services that they've purchased and they haven't yet paid for. So some companies have terms such as net 30 days. So you send out the invoice and they have 30 days in which to pay that invoice. A strategy you might want to consider is offering terms 2% 10, net 30. And what that means is if the company or the person pays that bill within 10 days, they can take 2% off. So they get a 2% savings and you get your money 20 days earlier. So there's some strategies you might want to consider to help with your accounts receivable. There's also accounts payable. So clearly, as a business, you're going to have some expenses. This is money that you're paying out or that you owe to suppliers for goods and services that you've purchased. So again, you want to take a look at your cash flow, see what makes sense with regards to money coming in and going out of your business, how you manage your accounts payable. And then inventory, the raw materials and finished goods that are purchased from suppliers and then sold to your customers that generate revenue. So when you buy inventory on credit, it creates your accounts payable. And when you sell it on credit, it creates accounts receivable. If you happen to, monitor your cash flow very diligently, you're going to be able to see certain trends, and these trends might be able to help you analyze when is the best time to purchase inventory and supplies for your business. So just looking at managing your cash flow projections, the first thing you want to do is plan your year. So first, think about what it is you want to accomplish over the next 12 months, and this is going to be based on your business plan. With a clear idea of what you want to achieve, you can start estimating your annual expenses in addition to the costs you'll incur to implement your business plan. Some expenses that you can take a look at are the ones that are for the day-to-day operations, such as payroll, rent, utilities, interest, loan payments, marketing. And you should also consider anticipating any big ticket items, such as if you're a new business or you're looking to grow your business, or even if you're buying new equipment, redesigning your website, or updating computers. So you want to take all these into consideration. Making projections is based on past experience if you've been in business for over a year. If not, you're going to have to anticipate what these projections are going to be based on research you've done and, as I said before, your business plan. You also may need to be able, or you might need to arrange financing. So determining the cash flow projections helps you determine how much money you're going to need to be able to float the business for the year. So the start of the year is a good time to arrange any needed credit lines or business loans, and working out payment terms in advance is really helpful. Then you can add those numbers into your cash flow projections. And then you really want to monitor and adjust your cash flow projections, because nobody ever gets it right the first go, and there's unforeseen expenses that come up. Things happen beyond your control with regards to sales. Sometimes they're higher, sometimes they're lower. So you really want to be able to monitor and adjust your cash flow as need be. So it's not a stagnant document. It's one that you will take a look at on a monthly basis and make sure from month to month you're able to handle the money coming in and the money going out, and you don't end up with a deficit at the end of the year. And as I said, getting help, depending on your in-house resources, you might consider outside help in creating financial projections or even monitoring your progress through the year. So that might be using someone from the small business office, it might be hiring your own bookkeeper or hiring an accountant, but having somebody, maybe for the first little while at least, go over your cash flow projections and taking a look at your actuals and making those adjustments as need be. So this is the cash flow projection template that I sent out, and I'm going to change my screens now because I'm going to go into my Excel spreadsheet and go over each line item as to how you would calculate what those sales are, what those expenses are, and how it's going to leave you at the end of each month. So let me just switch over here. Okay, so this is the cash flow forecast for the year. This is the template that I sent out to you. There is a cash flow forecast, the cash flow actual. I've even included a couple of other forms that if you have inventory, you can just put the information in these forms and it will change. So for example, if you had an invoice, you could put the item number in and the description, and then say the unit price is, maybe it's $10. So the inventory value automatically changes. And if you ordered 50, it shows you sort of how many is in inventory, what your record level is, and when you need to order. So that's a nice little option. We also have a little invoice tracker here if that interests you, and an accounts payable tracker. Again, they're all easy to figure out. You put the invoice number and the date due, the customer name, the amount of the invoices, any late fees, how much they paid, when they paid it, and then if there's any outstanding balances. So this is really nice to be able to keep track of your accounts payable and your accounts receivable, but we're not actually going over that today. They're just a couple of extra spreadsheets I put in for you to use if you choose to. So the first thing we're going to take a look at in when we're filling out the cash flow forecast, and again, it's based on your business plan. So all the information that's going into this cash flow forecast is in your business plan somewhere. So I usually like to start with the easy items to fill in. So I'm going to start from the bottom and move up. So utilities, hydro, and or the internet are really easy to figure out. So I know that for telephone and internet, I'm going to purchase a new phone, set up a subscription, and get my internet. And my research has shown that as a startup cost, that's going to cost me $250 based on the plan that I've decided to take. When I populate the spreadsheet, you can see at the bottom here my opening balance, my net income or loss, and my closing balance changes. So as I populate this section, you'll see that the numbers start changing. Now, if I do a Control C, which is to copy, and then do a Control V, as in Victor, we'll paste the information because I know that my monthly telephone and internet charges are going to be the same based on the plan that I've chosen. It also gives me how much I've spent for the year, or how much I anticipate spending for telephone and internet for the year. And again, you can see that this is populating. So we've done telephone and internet. As I said, this is a seasonal business. I'm not going to let you know what type of business, but the fact is it is a seasonal business. And for part of this, we do have to do training. Now, we're not renting an office or a location, so I'm going to take this line out and change it with training, because I know that I'm going to have training costs as a startup cost, and I know they're $500. So again, you can change any of these expense categories. What I recommend is when you first download the template, save it as a master file, and then save another file as a working copy. And then you always have the master file in case you accidentally change any of the formulas in these cells, and that will help you move forward. The next one I'm going to put in, because I know what it is office supplies, and I need to equip my office to get started. Once it's equipped, I don't anticipate I'm going to have a lot of expenses. I'll probably need a few pens and maybe some paper, but other than that, so I anticipate quarterly, I'm going to be spending about $25 on that, nothing serious. All right, so once I've got my office supplies in, the next area that is easy to determine because of research is my insurance costs. So I'm going to go here, but I have two different insurances. So I can either put it on one line, so I'll have vehicle insurance because we have a designated vehicle for this business. And I also have business insurance. So I can either put them together on one line, or I could actually add a line. But for the sake of this, I'm just going to put them on one line. So this is going to be both vehicle and commercial insurance. So I know that with any insurance policies that I have, and I'm going to be paying the premiums monthly. So the first month I'm going to have to pay first and last month insurance, which ends up being $600. Again, this is for a commercial vehicle and commercial insurance. And then I'm going to be paying $300 a month for the rest of the year. So again, Control C, you can copy that cell. Control V, you highlight the cells and you can paste it in. The next area, it's a new business, and I know I have to register my business, so that's $60, so that's a startup cost. I've talked to my bank, and based on the plan I've chosen, it's $45 a month. So again, I'm just populating expenses that I'm really sure about because I've researched that already. From my marketing plan, I know I'm going to have a fairly aggressive startup marketing promotion. And then the way that my marketing breaks down is this. So again, all this information is coming from my business plan. Because this is a seasonal business, I only anticipate I'll need to market to the 7th, and possibly I might not even have to market that far in advance if all goes well, but we've budgeted for a worst case scenario. Okay, so that's all the stuff that I really can put in. Those are the first items that I put in. What I do secondly is start thinking about my sales. So what do I anticipate my sales are going to be? So I can break it down by product or service, but I'm just going to do it with the product and service together. So what I'm going to share with you here is this is from the business plan. And what I've worked out is because it's a seasonal business and the business will run from April 1st to November 1st. This represents 154 weekdays and 60 weekend days. So 30 weeks, a total of 214 workable days for the season. So I probably am not going to work 7 days a week. And plus, there's going to be some rain days in there. So based on my 7 years experience in this form of business, I anticipate that I'll be able to work 130 days through the season, whether it's during the week or weekends. So because it's seasonal and I know how the seasons work, I anticipate based on weather how many work days there are per month. And this is based on rain dates in Ontario for each month. So I anticipate these are the days that I can work each month. I anticipate, based on experience, that I can do 3 jobs a day. And I also know that the average job, based on research and experience, is $258 per year. So this is for the one service. So this is what the sales translate per month. I also have a second service, but it's not as popular, but it still needs to be done. And only a certain percentage of my clients are going to opt for service number 2. So I know I can do 2 jobs a day with an average of 150. It usually happens in April and May and October and November. So these are the sales for that. I add them together and I see what my total sales are month by month. So what I do now is go to my cash flow and I start populating. So I'm just going to round these numbers up or down, whichever the case, and put them in. Okay, so I'll just make this column a bit wider, and we can see I anticipate the sales are going to be $123 now, or $123,000. This is based on research and past experience. If I want to be a little bit pessimistic, I might lower the number of jobs that I can do a day to 2, maybe the first month that I'm starting out. But because we have a fairly aggressive marketing strategy to start, and I'm very familiar with the business, I anticipate these sales are fairly realistic. So let's take a look at what we have going on at the bottom. So we have some of our expenses in, we have our sales in. The first month we're operating at a deficit, so that's never good. But we haven't put all the information in yet. So let's just widen these columns just so we can see what's happening. And then we're going to populate with the rest of the information. Okay. So the second area, now that we've got our anticipated sales in, I'm going to go to the expenses, because now we sort of know what kind of work we're trying to do and what our expenses might be. So based on what I know that we have to do is there's going to be certain supplies that we're going to need on an ongoing basis. So I'm going to put them in under here. So I don't have cost of goods sold actually, because I'm not reselling anything. So I'm just going to change this to supplies that I use on a monthly basis. Supplies are things that you use on a regular basis and they run out and you have to replenish them, usually monthly, quarterly, or something like that. So we're just going to put those numbers in here. Okay, so we've got our supplies in. We know that there is another supplier that we have to deal with. So these are supplies from one supplier. I'm just going to top those up and add the other supplier's costs in, just so I have this right. And again, all this information is coming from a business plan. Oops, that's a little high there, isn't it? Okay, so you can see here, I'm probably spending about $15,000 on supplies. Based on these formulas, when I'm doing this next year, if I have done my research correctly, if these sales work out and these supplies are the same, then I can use similar numbers for next year. The supplies might go up in price, so I might anticipate a 10% increase. But again, doing the first year is very important to, as I say, anticipate what your sales are going to be. You should have a fairly good handle on what your expenses are, and hopefully everything down the road works out. Okay, so I'm not going to get into the equipment just yet, but I know based on my sales, I'm going to need an employee. So when I go back to my business plan, I can take a look at, based on the days that are being worked, so I anticipate, you know, the days and how many hours are being worked. We're working 15 days in April, 8 hours a day at $18 an hour is what I'm paying the employee. So we can see what our total wages are going to be for that particular employee based on what we've put in our business plan. So I'm going to go back to here and add the employee's wages. Okay, so we've got the employee's wages or salary. As an employer, you have to contribute to your employees' CPP and EI, and I usually calculate that at about 10%. So what I can do is put in a formula here, which is equals this number times, which is the star, 0.1, and that will give me the 10%. So as an employer, I have to contribute to CPP and EI on my employee's behalf. So I can just copy that formula across, and now I know what the benefits are that I'm going to have to pay as an employer. In this particular business, I have to insure this individual under CPP. So what I can do is I can insert a line and I can add WSIB. And I know, based on my research, that the rate per $100 is $1.67. So the CPP, or the WSIB I'm going to have to pay for this employee every month is this. Okay, and this number is. Okay, so we have the employee in there. Let's see what else we can add based on our business plan. So going back to the business plan, I'm going to calculate kilometers. So based on the geographic area for this business, I anticipate that I'm going to travel 75 kilometers a day, and I'm going to calculate 62 cents a kilometer. Now, the 62 cents kilometer represents what Canada Revenue Agency says, maybe realistically or unrealistically, what it costs to run a vehicle. It really is dependent on the vehicle, the price of gas, and that sort of thing. And we know that gas has gone up, so this figure is probably a little low. But 62 cents is what Canada Revenue Agency says that it costs to run a vehicle. That includes gas, oil, maintenance, insurance, plates, all that. So that's the number I'm going to use. And we can see that based on the number of kilometers I anticipate running the roads a day, my total expenses are going to be this. So I'm just going to add them in under motor vehicle expenses. And you can, as you're doing this for your business plan, if you find that the numbers need to be adjusted because of reality and your actual, then what you need to do is go through and change the formulas or how you've been calculating certain calculations. You may need to go back in and change them. Okay, and the last area that we know is for this business, because certain items need to be washed on a regular basis and the type of washing machine and dryer, we anticipate our hydro bill is going to go up every month by $75 based on what it is we have to do. So again, we can go down and take a look at where we are. Again, we're in pretty good shape. We've got a closing balance the first month, so we're in a deficit, so we're clearly going to have to put some money in. But what I'm going to do right now is just put in some extra information in that I know that based on my business plan, I'm going to be purchasing new equipment for this business because it's a new business. So I know based on the charts that I had done for all the supplies I needed and priced them out in my business plan, I need $46,000. So what this is, or I need $46,000 worth of equipment. So what this is telling me now is I probably am going to be operating at a deficit. So yes, I'm almost $50,000 in the hole the first month. And it looks like I'm not actually flush or making any money until the 7th month, which is never a good thing. You never want your closing cash balance in a deficit. But why I've done this right now and where I'm going to take you before I start looking at your owner withdrawals and your income tax and loan payments, because we're not quite sure what we need as a loan payment yet. What I want to show you is, based on this information, it looks like we're going to be making about $27,000 in profit. So you want to be able to anticipate what your expenses or what your CPP and income tax is going to be. So there are charts as to when you identify what your end value is going to be with regards to having to pay taxes. I need to put in the loan payments though. So let me think what I want to do here. Okay, so the loan payments I'm going to pay out, it looks like right now, based on this information, I'm going to need at least $25,000 as a loan. So let's put that up here and see what happens. Okay. Oops, that's not in the second one. Sorry, I've put it in the wrong place. Based on the cash flow, again, it shows that the biggest deficit we're going to be in actually is here. So that's $49,000, almost 50. Let's call it 50. So I need to get $50,000 from somewhere. So I know that my personal investment, I have $5,000 to put into the business. And I know I've also applied for a grant for my employee. And I think to feel safe, I'm going to put in $45,000. I think that's what I'm looking for in a loan. So let's see what that does to our cash flow. Okay, so now we're looking good. The closing balance here is $4,600, and my sales are coming in, so I'm looking pretty good here. Because the business is seasonal, I'm going to see here that I'm going to be operating monthly at a loss, but as long as I'm in a positive in the closing balance, then I'm in good shape. So other things that I need to consider here are, I'm going to want to pay myself. So I'm going to need to take owner's withdrawal. So I need to see what that looks like. So based on my monthly bills, I anticipate I would need $2,500 out of the business every month. So I'm going to put that in and copy that cell across for the 12 months, because even though I'm not working in certain months, I'm going to need to take money out to live on. I've also anticipated, based on my revenues, I'm going to be paying income tax and CPP, and I'll show you how I came up with this number in a minute, I need to set aside $1,500 a month to be able to pay my income taxes at the end of the year and my CPP. And keep in mind that you have to pay CPP for yourself and as the employer. So as a self-employed individual, you're actually paying both sides of the CPP. So how I determined what my taxes are going to be is there's this little calculator. That's not the one. There's a little income tax calculator that I found. It's at this website here, and I can put that into the comments or the chat. So what you do is you anticipate after your expenses what your salary is going to be for the year for Ontario, or you can do it whatever province you're in and then calculate. And based on what the results come up, this shows how much you would be paying federally, how much you'd be paying provincially, your CPP contributions, and you don't need to include the EI deductions because as a self-employed individual, you wouldn't have that. So it looks like it's about a 30% rate. If I was only making income for the year of my business and I was only making $50,000, the numbers change. So you would calculate, and again, the average rate would at that point be 27%. So I always try to put the income tax and the CPP that I need to pay at the end of the year in my cash flow, and I also keep it in a separate account. So when I'm opening a business account for my business, I have my current account or my commercial account, and then I link a savings account to it. And how I use that to manage my cash flow is when I invoice clients and I collect the HST, I put that into the savings account. And then every month I put in what I anticipate I would have to pay monthly for my income tax and CPP into this account. So I call this savings account my CRA account. And then at the end of the year, when I have to remit my HST and I have to remit my taxes, then hopefully I have set aside enough money in this savings CRA account to be able to pay the government. Companies really get into trouble, especially the first couple of years, because they may have collected HST and they may have to pay income tax at the end of the year, but they haven't put it in a separate account. And what happens if it's in your commercial account is your mindset thinks you have money in the bank to buy products or to buy equipment or to pay yourself. And at the end of the year, when it comes time to paying your HST and your taxes, you don't have that money in the bank to pay them. So not only is there penalties, but they also charge interest. So if you owe the government at the end of the year penalties and interest, they charge a lot. It's like 20–25%. So if you do this for a couple of years, you can quickly put your company into bankruptcy. So I strongly recommend that you put aside your HST and income tax and CPP based on what you anticipate your income is going to be at the end of the year. And that's another reason why you want to do this cash flow forecast, is to anticipate what your income is going to be at the end of the year after you've taken your expenses away from your sales. So we've put our income tax and CPP in, but we haven't put our loan payments in. We know that we're looking for a loan for $45,000, but we still need to make those loan payments. So based on talking to the organization that I'm going to be getting a loan from, and I negotiated that I'd like to pay it back over 2 years because I anticipate the sales will be good and that I'll be able to do that. And you might decide for $45,000 you want to pay it over 5 years. It's really dependent on how you're going to negotiate with the lender. But I'm going to try to pay this off over 2 years, and I know to be able to do that, my loan payments are going to be $2,550. So I'm just going to put those in and take a look at what that looks like. Okay, so I've done that. I feel fairly confident that I have all the numbers in from my business plan. I can see that with the loan and my startup expenses that I still have $5,000 left at the end of the year. I've taken into consideration travel, or not travel, but my car expenses. I've taken into consideration loan payments that I'm going to pay myself. So let's see, at the end of the year, everything should be in a positive state, and it is. So what this means is at the end of the 12th month, even though I'm operating in a negative position for the months I'm not working, I'm still being able to pay myself. I'm still being able to make loan payments, and I'm still paying for all the monthly expenses that I'm going to have, whether or not I'm making money. And I still end up with $6,000 in the bank at the end of the year to be able to start year 2. So I'm going to go back to the presentation, and then we'll just finish up with that. And if there's any questions, I can answer those questions for you. Okay, so we've finished here with the cash flow projection sheet completed. So again, you will have that either it was sent to you by Janelle or it's in the chat box at the top there. You can always just download it from there. And we're going to take a look at some cash flow metrics that you may want to analyze at a glance. So the first one is anticipating what the average collection period is. So what that means is the number of days it takes for your customers to pay you on average. So even though we made those sales in the first month, we might not get paid till the second month. So we would have to anticipate that in our cash flow projection and maybe add another column as to these are the sales that we anticipate for the month, but this is how we anticipate the money flowing into the business. If you remember, the cash flow is how the money is flowing in and out of the business. We also want to take a look at average days payable. So what is the average number of days it usually takes you to pay your bills? So even though a bill may have come in month 1, you might not pay it to month 2. So you have to take that into consideration as well. I have a question here that I will answer. The question is there a resource that makes making a business plan easy? I've been running for almost 2 years without a formal plan and want to do one up. So that is a great question. And I will let Jennifer answer that, or Janelle answer that for you, because their office will help you with that for sure.
Hi, Carly. Yeah, I just popped back on, put my video back on so that hopefully we could connect, but I have a number of, or a variety of resources that can help you find an easy way to develop a business plan. And there's really no right template or a better one. It's really finding one that works for you. And I have a number of different resources. So, if you'd like to connect, I can certainly send you an email, Carly.
And the other nice thing about the Bruce Business Office is they run these workshops on a continuous basis. So they likely will have a business planning workshop coming up within the next couple of months. You may also want to sit in on, but I'll let Janelle tell you all about the resources that they have at their office. Thanks for the question, Carly. That was great. The next metric that you want to always have at a glance is cash on hand. So the cash on hand is money that you have in the bank, plus any available room if you have a line of credit or a credit card. So I always recommend getting a business credit card in the amount of $5,000, just in case you're running a little short and you have to make purchases. It's also a really good way to help you manage your cash flow, knowing that, if you put all your supplies and gas and all that on your credit card, you can see on the credit card statement all the gas receipts, all the supply receipts, and then I would make a practice of paying that off every month. But that's a really good cash flow strategy to use as well. And days inventories outstanding. So what this means is how many days does it take to sell your inventory? So what is your inventory turnover on average? You might find that there's certain things that sit on the shelf for a really long time. At that point, you may want to decide, is it a seasonal item and I just bring it in certain seasons? Is it an item that's just not selling and I'm not going to carry it anymore? Or are sales just slow in this, and this might be an item that you want to market or use as a loss leader to get people into your store or buying online or using your product or services. So there's some different strategies you can use with your cash flow. So again, you want to make sure that you can see what's going on in your cash flow at a glance and being able to anticipate any trends. And then inventory turnover. So again, the number of times you sell your inventory in a year. So you're going to find maybe that there's certain items that turn over very quickly, and there's some items that turn over slower. So you could base your purchasing on when these items turn over. So again, is it seasonal? Is it industry related? And take a look at, one, how many days does it take to sell different pieces of inventory, and then how quickly does it turn over? And that little inventory spreadsheet in the templates that I gave you can help you analyze that. So I'm going to give you some tips to collect money a little faster, because this really affects your cash flow as well. So the first one is send invoices promptly. So get invoices out fast. The earlier you invoice, the sooner you get paid. And be sure to send invoices as soon as you ship or complete a job, and send them out by email. People will get them faster. Some people still use snail mail, and if your industry does that, I would also send one via snail mail, but I would also send one via email if you can. If you're working on a large job, consider negotiating upfront deposits and progress payments. So say you're in a job and you do landscaping, and maybe the job that you're doing is $20,000, and it's taking place over a number of weeks. You might ask for a 50% deposit, and then another 25% when the job is halfway done, and the final payment upon completion of the job. So this helps with your cash flow as well. And getting a 50% deposit will likely pay for all the goods that you need to purchase, or all the supplies or equipment that you need to purchase before you do the job. So at least in a worst case scenario, if they don't end up paying, at least you've got your goods covered. You should also consider using mobile technologies to collect faster. So if you're in a situation where you're doing a job at somebody's place, you might be able to send the invoice right then and there and ask them, did you receive the invoice? They say yes. Would you like to pay via credit card or e-transfer? And you might be able to get the transaction completed right there and then. So that can really cut down on mailing and paper costs. The next is automated invoices and payment reminders. So again, if you send out an invoice and are using a software such as Wave, you can automate the invoice so it goes out, but then you can send reminders every 7 days or 14 days or just at the 30 days. If you have an ongoing relationship with the client, using this invoicing platform to automate your invoices is really handy. And you can also accept credit card payments. So by accepting credit card payments, you tend to get paid a lot faster than sending an invoice and then waiting for a check to come in the mail. You can also set up recurring invoices on automated platforms if you're providing a service that you bill monthly for. So you can set it up to duplicate the invoice every month, which is really handy. Another way is to offer discounts, and as I had mentioned earlier, if you offer 2% 10 net 30, that means if they pay the invoice within 10 days, they get a 2% discount. If they do business with you on an ongoing basis, this might be a great savings for them, and it might help you with your cash flow getting paid 20 days earlier. And again, similar to a deposit, freelancers and entrepreneurs sometimes ask for a deposit or retainer to do businesses. Some businesses offer that do this would be wedding photographers, or if a company is helping you with graphic design and that sort of thing. And quite often, retainers are non-refundable. So it might be just a retainer of 10 to 30% just to hold the date for an event for a photographer, for example. So this is another way that you're not holding the date and then at the last minute they sort of bail on you. At least you've gotten some money from them, and hopefully we'll be able to fill that spot. And then the last one is to identify barriers to change. So considering setting up your business to accept credit cards and e-transfer payments. This helps slower payers speed up and be able to pay you right away. So being able to have that available to them makes a big difference. I know in my business it does. And using your cash flow to make data-driven decisions. So you can use your cash flow, it's like building a chart that will help you take a look at what's going on in your business. You can see sort of how sales are coming into the business monthly. Your business might be a business where it ebb and flows. So depending on the nature of your business, your sales should ebb and flow with what's happening within your industry. If you anticipate having deficits in a particular month, because maybe your sales weren't as high as you anticipated, you've got a couple of options. You can increase your sales, so improve your marketing strategies. You might want to sell out some surplus items to help make up the difference. If you find that you're having your sales are higher, you might be able to invest in new equipment or hire staff or revise your pricing and payment terms with whoever you have a loan with. So, there's a lot of things you can anticipate by analyzing and keeping abreast of what's going on in your cash flow. And then the last area I just want to take a look at is sources of funding. So if you're looking for sources of funding, this is sort of the sourcing pyramid, who you would go to first and who you would go to last. So usually you go to your personal resources first. This might be a little scary because it's like, oh my God, it took me so long to save this money, and now, I want to invest it or should invest it into my new business. Sometimes startup money comes in the form of using your credit cards. Sometimes it's a form of, getting a mortgage or a second mortgage, or remortgaging your homes, or selling property or possessions, or getting lines of credit. But usually a lot of companies do what's called bootstrapping, so using your own personal resources. A second option is to go to family and friends. So this is where family and friends might lend you the money, give you a startup loan because they really believe in what it is you're doing. Sometimes family members will gift you money to help you get your business going. Just know that if friends or family are helping, they probably will want to help you run your business, because clearly you won't be able to make those decisions yourself. Okay, a question. If accepting deposits, do we add this income in the month received? So in general reporting practices recommended by Canada Revenue Agency, they want you to use the accrual method. So what the accrual method is you report your sales the month they took place. So that would be the date on the invoice or the date of your receipt for that particular sale. You would report it in that month. So if you had a sale in March, you would report it in March. Even if you didn't get paid until April or May, you want to set up your books so you report the income the month it takes place. And the same for expenses. You might have an expense in March, but don't pay it until April or May. You would record that expense the month that it incurred. So, for example, we take tuition deposits before camps in September. You would record that tuition. Usually people would sign up for a program, and they would get some documentation that would say Joe Brown is signing up for a course in September. They are paying tuition of $3,000, and they are making their tuition deposit monthly from April, May, and June for that program starting in September. So I would put the date that you send out that agreement and take that tuition as the date of the sale, and then money would just flow into your business. Even though they're not getting the product or service until September, you're probably making all the arrangements for that sale this month. Now, if you're not sure or not comfortable with that, I would talk to an accountant, but that's how I would do it. So again, what I would do might not be the same as what you would do, but Canada Revenue Agency wants you to report the income when the transaction is made. So I'm thinking if you're making the transaction in April or March, even though it's not starting till September, I believe the transaction would be April and March. And you would record that they made a transaction, $3,000, and they paid, a portion of the tuition in April. They're going to pay another portion in August, and the sale actually took place in April. So I hope that answers your question. Another area for getting sources of funding is banks and commercial lenders. This can be in the way of a line of credit or a business credit card or possibly a loan. The one thing about banks is while they say they support new business, they really don't. I know this from experience. They will give you, so in that example that I showed you where they were looking for $45,000, the person who was looking for this money actually had money of their own in the bank just sitting there, but they only wanted to invest $5,000. The maximum their bank would give them was $10,000. So we decided to go to an alternative lender, which could be the CFDC. I'm sure you've heard of them. I'll just flip a slide ahead here. So there's community futures all across Canada. There's 267 of them. And they provide funding as a lender, sort of a second resource. So if you're turned down by a bank, chances are, as long as you have a good credit history and you're putting some skin into the game and you might have some assets they want to put a hold on, but as long as you have a good credit rating, a good business plan, a good cash flow projections, chances are you will receive funding from them. But going back, there's also government grants and loans. Oh, just one more point I want to make. I think the CFDC has loans of up to $150,000. So that's a good chunk of change as well. Banks and commercial lenders, we talked about government grants and loans. There's hundreds of government grants and loans out there. The challenge is trying to find the one that's right for your type of business and for what you want to purchase. With the money. So by saying, I'm looking for a grant of $45,000 isn't going to cut it. You're going to have to try to find what it is you're looking to spend that money on. So there might be some equipment grants out there. There might be some grants or subsidies to help you with wages. So you need to know what you would be using the money for. Crowdfunding for some types of business works, not all of them. I've seen it be very successful if you're coming up with a new product that you have a prototype of and you can show how it works, but you just don't have all the money together to be able to purchase what you need to get the equipment to build your prototype. What might happen is you get what are called the first investors, and they buy the prototype or they buy the product on spec, knowing that it might not be available for 8 months. However, if the price of the item is going to be $120, you might be able to get it before it's available at $80, giving the business that's making this product cash flow to be able to produce this product for sales in 8 months' time. So that's the type of businesses I've seen crowdfunding work well for. Angel investors is not what everybody thinks. Angel investors are not family and friends. Angel investors are a group of wealthy individuals who get together, and you would pitch to these angels, and if they thought that yours was a good company, they would invest in that for a share in the company. What usually happens with angel investors is they're looking for technology-based companies. Quite often they want to have some stake in the business, and they really like businesses that are going to be acquired or sold so they can get their money out. So they really want to, double or triple their money when they're investing in your company. And they look for projects, between $150,000 and $1 million. So that's sort of the angel investors. And then venture capitalists similar to angel investors, but they're looking for the huge product or projects. They really want those $1 million projects. But if you're in that space, then you sort of move up the chain. And if you're looking for millions of dollars or hundreds of thousands, angels and capitalists might be the way to go. So we've talked about the community futures. Your area will have one designated. There's also this website, and they have all the different business grants and loans that are available at all 3 levels of government. And how they set it up now, which is really nice, is you can, it will ask you questions. So what type of business are you? What industry are you in? What do you require financing for? Are you looking for a loan? Are you looking for a grant? Are you looking to hire employees? And then it just keeps asking you questions. And then once you finish answering the questions, you hit submit. And if there's any programs that are suitable for what you need money for, they will give you links to those programs. So it's a really good website. And again, I can share those websites, or Janelle can share them with you when she's sending out the package. So basically, in summary, what we've taken a look at today is having a thorough understanding of what your cash flow is. Again, cash flow is money going in and out of your business. It's really important that you understand what is going on within your business monthly, and you look at your projections versus your actuals and make any adjustments you may need. You want to be able to keep on top of your accounts receivables and accounts payable. So those 2 other little templates that will help you do that. It will show you who owes you money, what invoices are outstanding, how much is outstanding, and how old or how many days it's been since that person has paid you. So those 2 other templates are really handy. And then keeping abreast of how could you improve your cash flow? Should your sales be down, or should you have unexpected expenses? So being able to collect maybe accounts payable a little faster or accounts receivable a little faster. We've showed you a few techniques on how to do that. I'm sure Janelle could help you in that area as well. I would strongly recommend, once you've done your business plan and put your cash flow together, have Janelle take a look at it. She'd be very good at identifying any gaps that you may have in your cash flow or business plan. And the sooner you can do this for the next 12 months, the better it's going to be for your business. Now, just keep in mind, it does take time to put a business plan together and the cash flow, but after you have done it, you'll be very thankful that you did. So that's the end of the presentation. I'm going to stop the sharing right now. I'm going to come back on live, answer any questions you may have, and I am going to stop the recording.